Hi folks, David Waring here again with InformedTrades.com and today's lesson of the day. In our last lesson we finished up our course on the basics of trading with a look at the 20 components that every trader's business plan should have. Now that we have an understanding of the basics of trading, I'm excited to be moving on to the next phase of the InformedTrades.com trading courses, which will be an in-depth look at each of the markets which are available to traders to trade, starting with today's lesson on the Forex market. So let's get started.
There are many interesting things which can be pointed out about the foreign exchange market. However, there are a few major things that really separate this market from equities and futures. Probably the biggest advantages that traders of the Forex market will cite is that the market is by far the largest market in the world and that the main currencies can be actively traded 24 hours a day. The huge amount of volume traded in the world's main currencies each day dwarfs the volume traded in the equities and the futures markets many times over. This, combined with the 24-hour trading day, gives traders the ability to determine their own trading hours instead of having to trade within set hours as they would have to when trading stocks and or futures. More importantly than this, however, is that as the market is more liquid than the futures and equities markets, price slippage, or the difference between where you click to be executed and the rate where you actually are executed, is much smaller than in the stock and futures markets. The disadvantage here is that the real market junkies sometimes cannot pull themselves away from the screen while the market is trading and need the finite trading hours of futures and or stocks to force them to step away from the market. As my background is in Forex, I've seen many stock and futures traders burn out when trying to make the switch to Forex for this reason. There is more leverage provided to traders by most Forex trading firms than any other market in the world. Many firms offer up to 200 to 1 leverage, which if fully used would essentially take a 0.5% move in the market and turn it into a 100% gain or loss on the value of the account. As the most highly traded currencies rarely move more than a couple of percent in a day, this allows traders to tailor the Forex market to their needs, making it a conservative instrument when traded without leverage, or the crack cocaine of financial instruments when making full use of the leverage available. While the availability of leverage is normally seen as an advantage in the above sense, it is also one of the places where Forex gets its bad name. Many times new traders are lured to the market after seeing the ability to amplify returns by making use of all that leverage. What these traders do not fully understand, however, is that leverage is a double-edged sword, causing greater losses just as quickly as it can cause greater profits. As a result of this lack of understanding and the jackpot mentality that many new traders bring with them to the Forex market, many beginning Forex traders lose their money very quickly as a result. Unlike stocks, where individual company events have a huge effect on price movements, the most highly traded currencies are only affected by macro events like capital flows between countries and changes in government and or central bank policies. This is often pointed to as an advantage by Forex traders who feel that this brings less uncertainty to their trades than stock trades, which can be thrown way off track if a surprise happens, such as a CEO quitting or something similar in the micro picture. This, combined with the fact that there is so much liquidity in the market, also makes it a much harder market for someone to come in and manipulate the price to their advantage and to the detriment of others. The disadvantage here is that this also means less opportunity to gain an informational edge and to profit from that edge as well. Over the long term, the U.S. stock market has always gone up, giving stocks in the U.S. an upward bias when trading. As currencies are traded in pairs, when the value of one currency is falling, this automatically means that the value of the other currency is rising. This is an advantage from the standpoint of it means there's equal opportunity for profit in both long and short trades. This is a disadvantage from the standpoint of not having an upward bias working for you when you're in a long trade. The last characteristic that we're going to discuss is how the fact that the Forex market is an over-the-counter market affects us as traders. As this is a fairly in-depth topic, we're going to devote a full lesson to it, which is going to be the topic of our next lesson. So we hope to see you then. As always, if you have any questions or comments, please feel free to leave them in the comments section below. And good luck with your trading.